This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So continuing from example 2, suppose that B Limited had commenced trading on the 1st of October 22, preparing accounts for 6 months ended March 23. Discuss the group relief available in respect of Z plc, trading loss, for the year ended the 31st of March, if it were to consider surrendering the loss to B Limited. Well, if we look at this, Z plc, year ended 31st of the 3rd, 23. B Limited only started to trade on the 1st of October 22. So only this period of time here is it actually part of the group. So any loss that it wants to send, they're making a loss, they're making a profit. Any loss that it wants to send would have to be 6/12, because it couldn't surrender all of the loss because B Limited had only been part of the group for 6 months. So that's a bit of common sense there. You can see that if they're only just joining the group, then they can't possibly have loss relief for the whole 12 months because that's not fair, because B Limited wasn't even part of the group at this point. So a simple example there for us to look at. Now, example number 4. Beyonce Limited prepares its accounts to the 31st of March each year and has 2 wholly owned subsidiaries, J Limited and Z Limited. J Limited has been owned for several years but prepares its accounts to the 30th of June, while Z Limited started trading on the 1st of January and made a trade profit of $50,000 in its 3-month period to the 31st of March. Beyonce made a trading loss of £240,000 in the year ended 31st of March 2023. J Limited has TTP of $160,000 for the year ended June 22 and $280,000 for the year ended June 23. Okay, a lot of information there. Let's not do any panicking. Let's have a look at this question. We'll have a look at it. You keep the question there. We're going to have a look at this bit by bit. So we have B Limited, Beyonce, year ended 31st of March 23. 2 subsidiaries, J Limited, which has a 30th of June 23 year end, and Z Limited, which started in 2023. Okay, that's our group structure, and we've transferred that information here so that we don't have to keep worrying about what's going on. Okay, so we've eliminated those bits of information from the question. So we've done that bit of information. 2 wholly owned subsidiaries. We've dealt with that piece of information, J and Z. J prepares its accounts to that date. B started to trade on the 1st. We've already transferred that information into that drawing. That's important. Draw out your structure, put the information out. Now, we're going to, what we have here is known as non-coterminous year ends. So let's have a look at this. We've got B Limited. The 31st of the 3rd, 23, which starts on the 1st of the 4th, 22. That's its period, and it's made a loss of £240,000. I'm going to go back to the question and get rid of that, because that information has also been put into our answer. Now, J Limited, its year end is the 30th of June 22. So we've got 2 sets of accounts, 30th of June 23. Yes? Yes? Good. and it made profits of 160,000 in that first year and 280,000 in that second year. So here it made a profit of 160,000 and a profit of 280,000. I think you can see where we're going with this one, can't you? Now we have one more bit of information that we need to draw out. Z Limited, profit of 50,000 in that 3 months to March. Let's add that one in, and all the information is now in our drawing. So in that period here we've got Z Limited, and in the period from the 1st of the 1st 23 to there, it made a profit of £50,000. So I've taken the information from the question, which when I read it out would be like, oh, so much information. But what we've done now is we've put it into two little drawings. One, which is the group structure. And two, which is the profit situation, profit and loss situation. Now what we have to do is to work out, with these non-coterminous year ends, which bits of the loss, because that's what we're looking for. We're looking at B Limited's loss. How much of that loss can go to J Limited and how much of it can go to Z Limited. Okay. So J Limited, 30th of June 22. This first set of accounts, there are 3 months of that profit of 160,000. This bit here, from the 1st of April, April, May, June, 3 months of that profit, which is also 3 months of the loss of £240,000. So that works out at 40,000, and that works out at 60,000. So we've worked out which bits are in the same period, which they flow over each other. And it's always the lowest figure that you choose. So B Limited's loss was 240,000, yes? 40,000 can go to J Limited in this accounting period to set off against the £160,000 worth of profit, reducing it to £120,000. Okay, let's do it again. J Limited's accounts to the 30th of June 23. Let's have a look at our drawing. Now, the June 23, this period is 9 months long. July, August, September, October, November, December, January, February, March. 9 months. So we need to know it's the lower of the profit of 280,000, which is 210, or the corresponding loss of 240,000, which is 180,000. We choose the lowest figure, which is this one. So of the loss for Beyonce Limited, 180,000 of that loss can go to J Limited in this set of accounts to be offset against their profits of 280,000, reducing them down to 200,000. So after we've dealt with J Limited, we've got 20,000 left. So that loss can go in its entirety to Z Limited. All of that can go to them to offset against the profits at 50,000. So the rule is it's the lower of the profit or the loss in the corresponding period. That's how that works. Now that might be a question that you need to go through again. All right. Now I've ruled all that out simply because I transferred that information onto my notes to make sure that I understood what was on the question, and then I drew it out because that's the best way to do it, and then to do the maths, and it's the lower of, here we go, where the accounting periods of two groups are different, then group relief will be restricted to the corresponding or coterminous period, therefore necessary to time apportion both the loss-making period and the profit-making period to calculate how much loss may be set against the profit for each one. Okay, and it's the lower of those two that you need to be dealing with. Now, we've looked earlier at losses and how the rules for loss-making groups, 70% direct and 75% indirect, and we looked at that example with Z and A and B and C. Okay. Gains, slightly different if you want to be in a gains group. 75% direct holding. Now the indirect holding is now only 50%, and you can only be in one group only. You cannot be in two groups. You have to decide. So with the B situation, you might have to decide. Tax implications. There are some lovely tax implications for this. 3 major benefits, which makes it so much more beneficial to be in a group. Okay, so number 1, they can transfer assets between themselves without incurring gains. They are no loss, no gain transfers. Okay, no gain, no loss transfers. It's deemed to take place at a value equal to the cost of the asset to the owner, the person who owns it, plus indexation up to the date of transfer, that should say 17, up to the date of transfer. Now, group companies can make an election that part of the gain or the loss can be treated as arising in another company. So, second benefit, we're not transferring assets, we're transferring numbers, only numbers. So, a gain in one group, a loss in another group. You can put the loss over here, and that might bring them down below the limit. Or if these haven't got very much income and they've got a big loss, stick it with, because remember, gains and losses stick together. You cannot have a loss from a capital sale against other income. It only goes with gains. So you can transfer them, the numbers, from one side to another. That's one. The third one, group-wide rollover relief. So, Group A, they sell an asset. Group B buys an asset. You can do rollover relief within the whole group without having to buy and sell within your individual company. So the advantages of being in a gains group: your losses are better utilised, you've got rollover relief available group wide, and gains can be moved to a company with insufficient profits. Great advantages to being within a group. Now, capital losses. An asset does not have to be moved within a group company in order to match those losses and gains. As I said, gain over here, loss over here, put them together that way, or put them together that way. So companies in a capital gains group can make an election to deem any part of the current period gain or loss made by one company to be made by another. And we've got here example number 5, which will help us to understand this a little bit better. During the year ended the 31st of March, Large disposed of an asset resulting in a loss. So Large has a loss of 35,000. Smaller, which is a subsidiary, has a gain of 100,000. Large has TTP of 1 million and Small has TTP of 800,000, including the gain, and anticipates larger profits next time. What elections are available and how can they best be used? Let's discuss the answer in full here. For example, number 5. So it's called a matching election to deem any part of the gain or loss made by one of the group companies to be made by another member of the group. That's the rule that has been written out. It's called the matching election. So it allows gains and losses to be set off within the group rather than them carrying them forward because they stick together. Okay. Initially, therefore, it would appear that electing to either deem the loss by Large to have been made by Smaller, or deeming 35% of Smaller's gain to have been made by Large, would have the same effect of matching the gains with the losses. Either approach may be proposed, but there is a further issue to be identified that would suggest it's preferable for at least 50,000 of the gain from Smaller Limited to go to Large Limited. Both companies are large, okay, which, notwithstanding their size in the previous accounting period, will mean that they both pay quarterly instalment payments because they are large. Because that limit, because they're 51% group members, that limit means that the limit is divided between the two of them. One of them got £1 million profits, the other had got 800,000. Both of them are over the limit. Both of them pay quarterly instalments. So therefore, it would be beneficial, to transfer at least 50,000 of the gain from Smaller to Large, which will bring Smaller's profits down from 800 to 750, removing them from the need to make quarterly payments. This result would not be achieved if the loss was transferred to Smaller, as it would still leave Smaller within 750,000 excess. Now, that not the simplest of answers, but basically if you get a question that explains, you go back to the questions, you've got this situation. This information here is important information. So if we've got Large has got profits of 1 million, which includes the gain. Smaller has profits of 800,000, okay, which doesn't include the loss. Now, if we put that over here, then we can bring them down below that limit, and therefore they won't have to pay by instalments, which means the cash flow will improve because we don't have to pay by instalments. So that's the end of the CT chapters. So a little bit of a review, you'll be able to watch that next.